Welcome to The Explainer. I'm your host Harsha, and today we are tackling a concept that honestly totally changes how we think about wealth. We are talking about engineering a sustainable second salary. We are going to explore the architecture of equity-based income, pulling from some really fantastic data and insights. Our goal here is to see exactly how you can break out of that traditional cycle of just trading your time for money and instead literally build yourself a passive wealth machine. So, let's just get right to the ultimate question. Is it actually possible to replace your professional earnings with a passive income stream built entirely on dividends? Well, think about what a second salary really implies. Let's dive into a refreshing approach to equity ownership. Imagine prioritizing durable, predictable cash flow instead of the constant anxiety that comes with speculative price jumps. Instead of gambling on stock prices, hoping they'll rise so you can sell for a profit, we're focusing on true ownership. This means investing in assets that generate consistent returns, providing you with stability and peace of mind. By embracing this strategy, you can build a solid financial foundation that stands the test of time. Let's explore how this approach can transform your investment journey. Getting started with powerful investment strategy that can significantly enhance your financial future. Did you know that dividends account for a massive 31% of the market's total return? That's right. You don't even have to sell a single share to enjoy that entire third of the market's historical performance. Just think about the profound impact of that for a second. You receive tangible returns deposited directly into your bank account, while your principal capital remains fully invested and continues to grow over the decades. It's like having a built-in safety net. This consistent cash flow offers incredible downside protection during severe market downturns. Even when prices drop, the cash keeps flowing. Now here's our blueprint for today, starting with section 1, the dividend income blueprint. First, let's explore the life cycle of a dividend. There are 4 key steps that show how value transfers from a corporate boardroom directly into your brokerage account. First up, the board of directors announces the payout on the declaration date. Next is the ex-dividend date, a crucial threshold. Think of it like the RSVP cutoff for a big party. If you're not on the guest list by that day, you miss out on the cake. You need to buy the stock before this date to receive the upcoming payment. Typically, the stock price drops by the exact amount of the dividend that morning. After that, we have the record date, when the company finalizes its shareholder registry. Finally, there's the payment date, which is your literal payday for this second salary. Now, let's move on to section 2, core metrics and yield traps. When we are analyzing safety, the very first metric you need to check is the payout ratio. Think of it this way: if a company earns $1 and pays you 50 cents, they have 50 cents left over. A healthy payout ratio, generally below 60% for typical companies, indicates that the business isn't overextending itself just to keep its shareholders happy. That leftover cash is absolutely vital for sustainable growth and stability. Understanding free cash flow is crucial for assessing a company's financial health. It's the cash available after a company has paid for its operating expenses and capital expenditures. This cash can be reinvested into the business, used to pay down debt, or help navigate economic challenges without cutting income. If a company's payout ratio rises into the 80s or 90s, it signals potential trouble for dividend sustainability, especially if revenues decline. You might ask, why not rely solely on net income? The answer lies in the fact that net income can be influenced by accounting practices. Free cash flow, however, provides a clearer picture. It's calculated by taking operating cash flow and subtracting capital expenditures, which are essential for maintaining operations. This metric reveals the true cash a company has available, making it a vital indicator of financial stability. Ideally, you want a company generating at least 20% more free cash flow than it pays out in total dividends. This ensures your buffer is made of actual cash, not just accounting tricks. But be cautious. Beware the siren song of a massive yield. Chasing the highest number can trap you in a yield trap. This happens when a stock's yield looks incredibly high, maybe 10 or 12%, but it's only that high because the share price has collapsed. Remember, yield is the annual dividend divided by the share price. If the stock drops by half, the yield doubles on paper, but the business might be failing. If a company's payout ratio exceeds 100%, they are bleeding cash. They may be taking on expensive debt just to fund your dividend, which is a ticking time bomb and the opposite of a sustainable second salary. Section 3. The royal-sounding categories represent the gold standard of portfolio construction. Dividend aristocrats are S&P 500 companies with a 25-year streak of increasing their payouts, while the ultra-exclusive dividend kings boast over 50 consecutive years of raises. Take Coca-Cola, for example, which has increased its dividend for 61 years. Think about everything that has happened in those 61 years. Recessions, double-digit inflation, global crises, pandemics. Through it all, Coca-Cola gave its investors a pay raise every single year. This resilience is what makes these investments so appealing. These companies are essentially bond proxies with an equity kicker, and they provide an incredible baseline of income that you can rely on to actually pay your real-world bills. But of course, there's always an exception to the rule, and here it involves real estate. REITs, or real estate investment trusts, are legally required to distribute at least 90% of their taxable income to shareholders, which makes them amazing yield conduits. But if you look at standard net income metrics, they look completely unprofitable. Why? Because owning massive real estate portfolios requires taking enormous paper depreciation write-offs every single year. So you have to use a metric called Funds from Operations, or FFO, to accurately judge a REIT. FFO basically adds that non-cash depreciation right back into the equation, showing you the true recurring operating cash flow those properties are generating to fund your dividend. Section 4. The power of reinvesting. A dividend reinvestment plan, or DRIP for short, automatically buys you more shares with your dividends. This offers massive benefits that can accelerate your wealth completely behind the scenes. It puts your money on autopilot, helping you avoid the temptation to spend those cash dividends on something frivolous. Instead of letting cash sit idle, a DRIP immediately purchases fractional shares, putting every single penny to work. Since this happens automatically every quarter, you benefit from dollar cost averaging. You naturally buy more shares when the market is down and prices are cheap, and fewer when prices are high. Plus, some companies even offer a 1 to 5% discount on the share price when you use their corporate DRIP. Embrace the power of reinvesting and watch your wealth grow. The game changer. Let's take an example. That figure right there is the 10-year value of a $10,000 investment growing at 7% with a 4% yield entirely due to reinvesting those dividends. If you had taken the dividends out as cash to spend, your account would be sitting at just over $25,000. That is almost a $3,000 difference over a single decade on just a $10,000 base purely from clicking the reinvest button. This is the compounding snowball in action, guys. Your dividends buy new shares, which then pay their own dividends the next quarter, which buy even more shares. It is literally a mathematical engine of wealth creation. Section 5. Depending on your income, you could legally pay 0% in federal taxes on these qualified dividends. Yes, literally zero. If we look at the 2026 tax landscape, if you are married filing jointly, and your combined taxable income is under $98,900, your qualified dividends are completely tax-free at the federal level. And even if your income stretches up over $600,000, the rate is capped at just 15%. I mean, compare that to a traditional W-2 worker who might be paying 24, 32, or even 37%. This preferential bracket is an absolutely massive structural advantage for the dividend investor. Section 6. Scaling your second salary. So, we've reached the stage where we scale up this architecture to hit that huge psychological milestone of $1,000 a month in pure passive income. There is an ultimate mathematical trade-off between capital and risk happening here. If you chase a percentage yield, you only need $200,000 invested to hit your $1,000 a month goal, but you are operating in highly sensitive territory, heavily exposed to potential yield traps and dividend cuts. If you target a 3 to 4% yield, that's generally your safest sweet spot. At 4%, you need $300,000. Now, I know that sounds like a lot, but you can build that reliably over time with high-quality blue chips and safe reads without having to constantly worry if your income is going to get slashed. Building this stream takes immense patience, and you'll move through very distinct psychological phases. In the early stage, you are hyper-focused on growth, using those drips to buy every fractional share you possibly can. You're letting that snowball pack itself tightly. In the mid-stage, imagine seeing your dividend payouts literally cover your monthly car payment or a chunk of your mortgage without you lifting a single finger. The theory suddenly becomes real life. And in the final stage, as you scale beyond $2,000 a month, your focus shifts entirely. You stop chasing aggressive growth and shift to capital preservation and inflation protection, really guarding that incredible golden goose you've built. So, your blueprint is ready and the materials are waiting. We've explored the safety metrics of free cash flow, how to spot those dangerous yield traps, the royalty of aristocrats, the compounding magic of drips, and the incredible tax advantages of qualified dividends. The architecture is all right here. The only question left is, what is the very first step you will take today to start engineering your own second salary? Thanks for joining me for this explainer, and see you on the next.